Hi, good morning, everyone. Thanks for joining the weekly research morning call. Today we have two stock counter updates, CNMC and Thai Beverage, followed by quite a few numbers of the monthly updates and the Euro Technical Pulse and Singapore Weekly. And so without further ado, I'll hand over to Glenn for Magnificent 7 Monthly. Glenn, please.
Yes, hi. Thanks. Sorry, give me a minute. Yeah, okay. Thanks everyone. Yep. So we have we restarted the MAG-7 monthly. But I think two of our analysts are on leave. So Yigban, who covers Nvidia, as well as Fahmi, who covers Microsoft, are on leave. So I'll be covering them. So we just start off with the earnings. Sorry, the performance for the MAG-7 in the month of May. So, excuse me. For the month of May, we saw a strong recovery for the MAG-7. I think only Apple was the negative, whereas the other six were all actually up. The MAG-7 overall was up around 12%, so it continued to beat the Nasdaq and the S&P 500. So despite this rebound, the MAG-7 was still negative for the year. It's still down 5% year to date. I think mainly after the initial crash in April that we saw from Trump's Liberation Day, investor sentiment was boosted by the moderating recession risk as geopolitical tensions between both the US and China eased slightly. And this benefited the big tech companies with, I think all the companies here have international exposure. And also, it also helped that the MAG-7 did release their results, and the results were mostly above estimates as well as above their guidance. The strongest gainers were Nvidia. So Nvidia was the largest gainer, mainly due to the easing trade tensions and the multi-year AI infrastructure project, which was announced with the Saudi Arabia Public Investment Fund. Tesla, despite their poor results, was the second biggest gainer for the month of May. Mainly, I mean, it not really to do with the fundamentals, but the fact that the CEO Elon Musk he finally left Dodge and is now trying to at least fully focus back on Tesla. And also there's a bit of anticipation regarding the robo-taxi pilot launch that will be happening in June. As for the laggards, Apple was the only laggard. It was down 6%, even though their results did beat estimates. The possible 25% tariff, which Trump did announce, and he said there was a possibility for phones that were not assembled in the US, was the main drag on the share price performance post earnings. They also did, flag this 900 million tariff hit for the second quarter, but I think Helena will go into more detail on Apple later. Now, moving on to the next slide. Yeah, we were looking roughly at just briefly, at each of their earnings. So all seven companies did announce their calendar year first quarter earnings. Most of it were beat or were in line with the expectations on both revenue as well as earnings. I think only Tesla missed expectations. For the digital advertising companies, Meta and Google, they were two of the fastest growing companies again, thanks to mainly the resilient consumer trends, high ad prices, as well as increased monetization for their AI-powered products. They also showcase significant operating leverage, which increased their earnings by 40% year on year. Microsoft grew by 13% year on year as well, mainly from stronger demand from the Azure which rose by 35% year on year. As for Amazon, their growth did slow down slightly, but they're still growing right now at 9%. As we did see consumer demand dampen. Their AWS growth has continued to accelerate as customers expanded their cloud presence. As for Apple, as I mentioned earlier, they did issue results that beat both the top and bottom line, but their iPhone sales growth, which makes up is still selling. It's just a phone company selling phones, right? It did struggle. It only grew around 2%. And despite their Apple Intelligence introduction, as China sales declined for the seventh consecutive quarter. Sorry, can everyone hear me? I think someone mentioned that I can't be heard.
Yeah, we
can.
Right. Okay. Okay. Thanks. Yeah. As for Tesla, it did miss estimates across the board, and I'll go into more detail later. But the deliveries did have this record year-on-year decline, and also, they have continued to lose market share to the China EV makers in both Europe as well as in China. Nvidia's results also beat estimates, despite the PATMI being impacted by a one-off charge, which I think the H20 chips now cannot be sold to China due to US exports restrictions. So for moving forward, for calendar year second quarter 2025, I think the guidance is that it will be a moderation in growth as they begin in lapping a stronger second quarter 2024. But we do believe that they will still be growing going into the next quarter. Now moving on to the next slide. Yeah, so I'll be covering for Iqbal. For Nvidia, it was really about the earnings, and guidance. So we did see quite upbeat earnings and guidance despite the impact that I mentioned from the US export controls. So they are still positive, for revenue and earnings guidance at around 69% and 50%. This was despite the 2.5 billion revenue impact and the 4.5 billion inventory charge due to the US export controls, mainly on their H20 chips to China. But they are still seeing this sharp jump in AI inference demand and mention the AI factory build-outs as the key revenue driver in the coming quarters. The gaming segment has also continued to outperform. It makes up around 9% of their revenue, and it was at a record 3.8 billion US dollars. This is the highest year-on-year increase since the calendar year fourth quarter, at around a 42% year-on-year growth, mainly driven by the strong demand for their AI PCs with the new RTX 5060, which runs on their Blackwell architecture. And they've also stated that this RTX 50 series supply will be improved moving forward, and they expect the sustained supply come from second quarter onwards. So we believe that Nvidia can offset the impact of the US export controls, especially on their H20 chip, by creating a new modified chip for sale to China. And China sales makes up around 13% of their revenue. So there have been rumors that this new AI chip, which is called B30, is really being designed for China, and that the growth, apart from that, the other growth will be expected to be driven by the Blackwell's ramp, as hyperscalers are still guiding for higher capex of around 59% year-on-year increase for calendar year second quarter. And with the end of support for Windows 10 PC in October of 2025 and the gradual transition to AI PCs, we believe that the demand for Nvidia's RTX 50 series GPUs will increase gradually in the next few months. Now moving on to the next counter would be Microsoft. Yep, so for Microsoft, it's covered by Fahmi, but he's on leave as well, so I'll be covering him. So for Microsoft, they did have a stronger than expected third quarter 25 results. Excuse me, give me a minute. Yeah, and they did deliver a rather healthy results again, with total revenue up by 13% year-on-year, and this is around 2% ahead of their consensus estimates. This is mainly driven by the robust growth in their intelligent cloud, which is their Azure. So Azure grew by 35% year-on-year, also outperforming their guidance of around 35% growth compared to 31.5% guided by the company, mainly supported by the continued cloud consumption. They also had their Build Developer Conference 2025 in May 19, and they unveiled advances in AI agents, development tools, as well as open protocols, and also this new Copilot tuning within Microsoft 360 Copilot, where they allow customers to train models on their data workflows and processes. And they also have the GitHub Copilot, which has become a full coding agent. And last but not least, at least in terms of the news, the US FTC dropped its case against Microsoft's US $69 billion Activision acquisition deal. So they cited the lack of public interest in continuing to challenge this long close 2023 deal. And I think this will allow Microsoft they said that the tie-up will allow Microsoft to fend off competitors to the Xbox console and its subscription, as well as cloud-based gaming business. So Microsoft did have a healthy share price gain of 17% in May, mainly driven by the stronger than expected results. And the the third quarter results highlighted that the strong demand for AI services is still outpacing Microsoft's supply ramp up. We also believe that the Azure demand will remain strong in the remainder of the year, supported by continued high customer interest. And their AI upgrades that they announced at the Build 2025 strengthen its position in cloud and enterprise AI. So these innovations position Microsoft to benefit from the rising demand for large AI models. And last but not least, as I mentioned earlier, the US FTC case dismissal lifts the market sentiment and reduces the risk of a deal unwind that could have affected Microsoft's gaming business, which makes up around 8% of revenue. We do have accumulate and a target price of $480. Now moving on to the last one so this is covered by me, which is Tesla. For Tesla, it was quite a disaster, I would say. I mean, the only positive that we saw was that the CEO returned. So Elon Musk did finally, exit his advisory role at Doge to fully refocus on Tesla. And he had begun to pull back in April, when he told investors during the earnings call that he will cut his time at Doge dramatically. And finally, he officially exited in May. And now, I think he's coming back, maybe with a bit of a disagreement with Trump on certain things. And also, he wants to come back in time for the pilot robotaxi launch in Austin, Texas, and also for the new Model Y launch in June. As for the other news, the market share in China and Europe, the sales have continued to decline, so nothing has improved. They had a 30% year-on-year decline in China, and also in Europe, they had a decline of 36% in Germany, 45% in UK, and 20% in Italy. So what makes it even worse is that despite on top of all these declines, it's not that the overall market isn't growing, right? In China, the overall new energy sales was up 37%, and in Europe, industry-wide EV sales was up 38%. So it's the fact that they are actually losing market share to the Chinese EV players in China and Euro markets. Lastly, for the first quarter results, it was a bit of a disaster. As I mentioned earlier, both top and bottom lines were missed estimates, mainly due to the lower auto revenue, lower margins, and lower average selling prices, as well as higher OpEx from AI projects. So their deliveries for that quarter had a record year-on-year decline. It fell by 13% year-on-year, and it's also the lowest since second quarter 2022. Resultantly, the gross margins as well as the average selling prices both declined. So despite this particularly disappointing set of results, first quarter results, Tesla's share price surged by 23% in May, right? Shares saw a huge gain from Elon Musk coming back to Tesla, which gave the investors confidence that he'll be back to helm the ship. But then again, fundamentally, we believe that there are a lot of headwinds still remain, mainly from the rising competition from Chinese EV makers, which is now not just affecting their China market share, but also their Europe market share. Their market and also this leads to the market share loss in Europe and China. And last but not least, the tariff pressures as well as the loss of the US tax credits, which would affect both the top and bottom line for Tesla. However, there are two, I think, potential upside catalysts, which is, I believe, why the share price has actually bumped up, apart from him coming back, would be the successful robo-taxi launch, which in Austin, Texas, and that will be starting in, I think, sometime in June. So I think by the end of the month, we could get some news on that, as well as some positive response to the new Model Y launch, and that was only being launched in June. So we will only see figures for that, I think, maybe in the middle of July, to see if this new Model Y has pumped up deliveries at all. We do maintain our sell recommendation as well as a target price of $200. So that's all I have for my counters. I'll now hand it over to Serena. Thank you.
Hi, thank you, Glenn. Good morning, everyone. I'm Serena. I cover Meta and Alphabet. So I'll start with Meta first. Meta first revenue actually beats guidance by more than 1% with 16% year-on-year growth to 42.3 billion compared to 36.4 billion in the first quarter last year. This is because of the 10% year-on-year higher advertising prices, especially in Asia Pacific. Family of apps ad revenue was $41.1 billion, is up 16% year-on-year. It's driven by e-commerce vertical. Other revenue grew quite significantly at 34% year-on-year, and it was because of the revenue growth from WhatsApp business platform and Meta Verify subscription. As for Reality Lab segment, is continued to be loss-making with the operating losses of $4.2 billion US dollar. This is because of the lower Meta Quest sales. And Meta actually finalized a $14 billion investment in the data labeling company called Scale AI, and they will have a 49% non-voting stake of ownership. And they actually hired the co-founder Alexander Wang to join the Super Intelligent Research Lab. So in financial year 25, Meta actually guided around 75 billion in capex to boost the AI infrastructure. So this deal is actually by far Meta most significant external AI related investment, and especially after they announced that they will delay the Llama 4 AI model because their in-house engineer actually struggle to improve the capabilities. So we actually do believe that the investment in Scale AI will improve Meta's AI capability and monetization opportunity over the long term in two particular areas. The first one is the specialization in data labeling can actually help Meta vision on pushing the advertisement automation. And the second one is we actually think that Meta is well positioned to pursue the next vision they want, which is the US government defense project after the deal, because the co-founder himself actually is very famous in lobbying with the governments on AI policy. So this is why Scale AI has a very strong business tie with the US Department of Defense. And the second one is because it allows them to have access to Scale AI ecosystem, which is already mature and ready to handle the defense contract. But we remain cautious on the potential scrutiny from the regulators because even though this is not an acquisition, they still retain the power to block it if they do see that it is anti-competition. If you look at the chart at the bottom right, this is the data from China officials. We do see that the export from China to the US actually dropped quite significantly in April and May, which is when the tariff started to implement. In May is around like 34.5%. But then we also do see that the export to Asia Pacific and also EU do increase quite significantly. And Meta management actually did mention that they do see some of the ad spending being redirected to other markets. So we hope that we do actually see this trend. Hope that the ad spending from the online retailers to EU or like Asia Pacific can offset a little bit of the impact to the US. Next, I'll talk about Alphabet. Yes, thanks very much. So next will be on Alphabet. So they deliver a quite resilient first quarter result with the total revenue up 12% year-on-year to 19.2 billion. This is driven by the strong momentum across all business segments. The search and YouTube advertising segment actually grows slow from 12%, but it's quite still very resilient at 10% year-on-year. It's driven by the financials and retail, and cloud revenue actually surged quite significantly at 28% year-on-year in the first quarter because of the larger scale and improved productivity and efficiency. So moving forward, OpenAI will actually enter a strategic partnership with the Google Cloud in order to cater the increased demand for the computing capacity, which is required to train and operate the advanced AI model. For OpenAI side, it actually helps them to diversify the cloud infrastructure and reduce the reliance on the Microsoft Azure because there has been an exclusive service providers to OpenAI since 2019 until January this year. And for Google, we actually do see that it can be benefits to Google Cloud business in terms of expanding the customer base and enhance the competitiveness against the major competition such as Amazon AWS and Microsoft Azure in a cloud business service. We actually do believe the deal can further advance Google Cloud business to become another significant source of revenue. Because like I mentioned it before, the business segment is having a traction at 28% year-on-year growth, and they're currently holding around 12% market share for the global cloud markets. At the same time, we still have to remain cautious on the Google search revenue under a more efficient ChatGPT competition, because as you can see at the chart at the bottom right, Google traditional search actually has been losing the market shares, and it's actually dropped below 90% since September 2024. And then you can also see that since October 2024, ChatGPT actually has been gaining more market share in the AI power search engine area. So this is why we remain cautious on this, because they are gaining a lot of traction. And then for Google, we actually maintain a buy recommendation with a target price of $250. That's all for me. I will pass the time to Helena. Thanks.
Thank you, Serena. I'll continue with Apple. So for Apple, their second quarter results were in line with expectation. We didn't really expect much. So iPhone sales was rather muted. It increased 2% year-on-year. And China market still remains really weak. It decreased 2.3% year-on-year. So the spotlight was what is the impact of the tariff. So the management, they guided the impact of the tariff. It could be around $900 million US for the next quarter, which is a little bit lower than we expected, but that is because they did a lot of precautions, like they're trying to ship across the border earlier in order to buffer the shock. So they do hint that it's going to be even higher for the further quarters. And recently they just have their annual WWDC. So this is where usually they will review their new innovations. But this time around, the updates center more primarily on the visual enhancement, like the new liquid glass. So this is really like it's not something that's like it's just a visually improvement. For the AI innovations, very few. It's only the AI translator. They're making LLM accessible to third parties. And there's also the visual intelligence, which is basically whatever you see on the screen, you can ask ChatGPT about it directly, or you can send it for a Google image search. We did expect the Siri AI features to be mentioned. That's what they forecasted earlier, but it wasn't mentioned at all. And actually, they just came out with the news that they're going to release the new version of Siri in spring 2026. So they actually got sued last Friday by the shareholders because people believe that they are trying to downplay the time they actually needed to develop the Siri, because this is a very people have been waiting for this one to come. This is the strongest of their AI intelligence. So all in all, we think Apple has been facing two problems mainly. One is their product growth has been pretty muted. Another one is the China market is not doing well. So looking at the product growth, we think it's gonna persist because looking at their WWDC, they haven't really came up with anything that's mind-blowing. Even the AI innovation that they did came up, there has been similar functions already available from competitors like Google and Huawei. So that really highlights just their slow pace in AI adoption. So we're likely not going to see the iPhone performance to improve tremendously. And in terms of the China market, they're still struggling a lot. In the first half of FY25, China market actually decreased 7% year-on-year, really because of the intensifying local competition. And now with the more macro pressure coming in, because Trump's tariff can still be a wild card, So nobody will, but that's only going to affect them negatively because that's going to increase their cost of production, while their Chinese competitors are likely going to suffer from that. So that's going to make the price competition for them even tougher. So in the short run, we think these two reasons are probably going to limit the upside in the near term. So we have a target price of $200 with a neutral rating. So moving on to Amazon. So Amazon's first quarter earnings were in line with our expectations, still very strong cloud growth. AWS grew 17% year on year. Their operating margin also increased by 1.9% year on year. This is driven by their server capacities optimization. So that really helps them to lower the infrastructure cost. And Amazon now, they're trying to focus on the lower price essentials in order to mitigate the tariff uncertainty risk. They have guided a continued high capex of $26 billion for the next quarter. So actually since May this year, they have announced the announcement they made of their commitment in the investment in data center. It has committed to a total of $52 billion. That include 20 billion in Pennsylvania, 13 billion in Australia, 10 billion in North Carolina, 5 billion in Saudi Arabia, and 4 billion in Chile. So it's really they're actively investing, and that sends a very positive image that they're seeing huge demand coming in, and they're trying to build more capacity in order to keep up with the demand. So pretty optimistic note on the cloud sector. So for the e-commerce sector, of course, they're going to be taking a hit because of the tariff, but they're trying to do their ways of trying to mitigate the issue. So one of the news that came out is Amazon and Walmart, they're trying to explore issuing a stable coin. So that kind of works as a digital token. It's usually pegged one-on-one to real world asset like US dollar. So they're thinking that by adopting that base payment system, retailers could be able to bypass the traditional payment network like credit or debit card. So that can actually help them avoid interchange fees on each card transaction. But whether it's going to work, it's still in the beginning stage. That really depends on the regulation, whether they're going to be allowed to do that. Another interesting trend we see is online retailers. They're scaling back on free shipping in response to the imported tariff because they simply just cannot absorb the cost. So a lot of the retailers, they're canceling free shipping. Some other retailers, like Temu, they've increased their shipping fee in a sense that previously, let's say you only need to buy over $15, they give you free shipping. Now they increase it to $35. Amazon is one of the very few platforms that their shipping policy remain unchanged, but that doesn't mean the price doesn't go up at all because they still have a lot of third-party sellers on the platform. They of course have to raise the price in order to absorb the added tariff burden. But all in all, we remain pretty constructive on Amazon, despite the macroeconomic headwinds, because we're seeing very strong momentum in the cloud sector. Seeing from the very active investment in capex. So that's continued to scale profit meaningfully. It helps to really offset the pressure in the retail side. And the retail side, we think given Amazon's scale and their sourcing flexibility, and now their strategic force to really focus more on the lower price essentials, it kind of positioned it well to navigate these challenges and cushion the pricing shocks compared to other e-commerce players. So all in all, we expect Amazon to remain a relatively e-commerce outperformer in such an environment. So the below graph is just to show the US e-commerce sales. Actually, we haven't really seen the dip coming in yet, and actually for the last quarter, it even went up a little bit. That is because consumers, they're bracing themselves for the increasing price in the future, so they're trying to stock up and overspend for now. So we haven't really seen the effect kicking in yet. We're going to be keeping a close monitoring. So overall, we have a target price of $260 and a buy recommendation. So next slide, please. This is just a summary of what we went through. So overall, we remain overweight on MAG-7. They mostly beat revenue expectation, and their growth has been stable. It's still 14% year on year this quarter and last quarter. Digital ad performed best fundamentally. They have significant operating leverage, which boosts earning growth to 38% year on year. Cloud hyperscalers, we still see the revenue and margin accelerating. EV demand in China and Europe are still increasing, even though Tesla is losing market share. So that's all from my sharing. I'll pass my time to Darren.
Yeah, thanks, Helena. Yeah, I'll run through the REITs monthly. So the title's privatization season, as we saw a couple of offers and Paragon REIT got privatized as well. Yeah, so before that, this is just a share price performance of the past month, or rather a month in May. We see there's a interesting trend where the those that didn't perform well in May were actually perform very well year to date. So it's like a kind of a reversal. Like we saw the diversified was in May was down 2.8%, but actually year to date is still up. Well, towards the right side is we saw the gains like 11.3%. That's mainly because of iREIT. It's basically just with getting back the gains that they lost over the past or year to date. So as a result, is still down. Yeah, next slide, please. Yeah, so for the theme for this REIT monthly, basically is privatization season. So Paragon REIT, as you all know, it got privatized on June 6th. So that's a few weeks back. Phillip Hospitality Trust, there's an offer to take it private at 71 cents, and Acrofight Hospitality Trust as well. They're undergoing a strategic review, so it is possible that sponsors might come up with an offer soon. Yeah, it's already announced as well. And so why we think this is happening because of we think it's some structural factors because of this. So first of all, it's small to mid-cap nature of these REITs. So Paragon REIT is a rather mid-cap, about 2.5 billion. FHT also about 1.2 billion, and Agrofire Hospitality Trust is a small cap, so it's about 200 200 Singapore dollars, 200 million Singapore dollars market cap. Yeah, so because of this small to mid-cap nature, their cost of capital will be higher as well compared to those larger cap REITs for sure because of the higher unit risk. And also because of scale, there are also fewer acquisition opportunities for them. And if they want to acquire any big assets, they need to equity fundraise. So that is also a challenge for them in this market. So as a result, there is diminished investor interest for these. And another factor is the low trading liquidity in the markets, as well as concentrated ownerships of sponsors or strategic investors. So for instance, you see Paragon REIT sponsors and strategic investors own 58%. FHT, like FPL, own 64%, and Agrofire Hospitality Trust similarly 49% is held by insiders. So as a result, the free float is 50% or less. So that also will affect the trading liquidity or trading volume of these shares as well. So as a result, this limits market appeal. So some of the sponsors, they might decide to just take it private because of the low trading liquidity, and it doesn't make sense to stay listed. And another factor is the persistent discount to NAV. So some of these REITs are trading at deep discounts to NAV. So if the sponsor wants to take it private, it's easier for them. Basically, if the REIT is trading at a high price to NAV, when the sponsor wants to take it private, they have to pay even higher price to NAV. So it's not so attractive, but if they're trading at a steep discount, so it's easier for them. So one example is Paragon REIT. So over the past year or 12-month VWAP, based on 12-month VWAP price, the price to NAV is 0.93 times. The offer was at 1.07 times. So the sponsor did pay above book as well, and it got taken private eventually. So FHT similarly. So over the past 12 months, the price to NAV is 0.71 times, and the offer is also above book at 1.11 times. So we think that's a decent offer. It's fair and reasonable. And Acrofight Hospitality Trust, right now they're trading at a steep discount, 0.4 times price to book, so 60% discount to book value. So we think similarly there might be another positive offer for that as well. Yeah, so moving on, next slide. So we move on to our usual monthly stats or data that we track for the REITs. So the 10-year dividend yield spread, we see it ticking up. So that is in line with what we expected originally, where the 10-year yield will continue to fall or decline from more interest rate cuts. And as a DPU, the absolute number of the dividends that the REITs pay continues to increase from interest rate cuts as well. So you see it increased month on month by 0.1%. Yep, and the 3-month SORA also continues to decline. So it declined 8 basis points month on month. So this is at the lowest point since October 2022. So that's at three-year low. So the REITs will continue to benefit from this as 3 months OR continues to decline. They'll benefit from that on the floating portion. And yeah, next slide, please. Yeah, so for forward dividend yield, it continues to improve, but that's partially because of the lackluster share price performance. But going forward, we expect it to increase also from the proof in the absolute number of the absolute DPU amount. And price to NAV is also trading below COVID-19 lows. So we think at this point it is attractive, as usually you see in the past, when it's trading at about 0.8 times, the share price usually will rebound. So it's been around 0.8 times over the past 2 years. So we think share price recovery might come soon, possibly end of this year or next year as things get better. Yeah, next slide, please. Yeah, so for subsector preferences, we still prefer the retail subsector. Retail sales are flattish or grew 0.8% year on year. So we still see occupancy costs below pre-COVID levels. So there is room for tenants, or rather for landlords, to increase the rents. So we've seen really resilient positive rent reversion so far this year as well as last year in the high single digit for suburban malls and low teens for downtown malls. So we think that's likely to continue this year. So our outlook for retail is still strong, especially the potential for rents to keep improving or increasing. And this is also boosted by the fact that there is limited incoming new supply in the market. So that will support rent as well. Yeah, next slide, please. Yeah, so for hospitality subsector, we continue to track this monthly data. So for visitor arrivals, it's up almost 8%, but it's still trending about 8% below pre-COVID levels for the month of May compared to May 2019. So overall, we're expecting it to reach about 95% of pre-COVID levels for the full year this year. And hotel RevPAR also is flat. It's down slightly 0.6% this year, and it is already trending above pre-COVID levels by 14%, and we think going forward, the RevPAR is likely to be low single digit for the full year as well. As the week Q1 is over, we saw some weak numbers, especially from the strong lineup, concert lineup last year. But this year, we think, yeah, the RevPAR will likely be low single digit as well, as there is some big events as well coming up, like the World Aquatics Forum and such. Yeah. So next slide, please. Yeah, so this is a snapshot of our coverage and target prices as well as the dividend yield and our forecast as well. Yep. So that's all for me. I hand over time now to Miao. Thanks.
Thanks, Darren. So we have an updated report on CNMC Goldmine. So they invested 9 million to expand their CIL facility to raise the capacity from 600 ton per day to 800 ton per day, which is around 60% increase. And the trial production has successfully completed. So we do expect gold sales volume to rise by around 20% year on year in FY25. And additional upside catalyst is expected to come from the second gold mining facility at Suko, which will be completed by second half 25. So this is to gain access to higher grade ore. Yeah, so we expect upside to come from the second gold mining facility. With the higher recovery rate from this facility, there will be higher production. So we foresee EBITDA margin to expand by around 1.6 percentage point year on year to 38.8%. And the second point is gold prices at record high. It surpassed $3,300 per ounce last week, which was representing a 30% increase year to date. And the rally was driven by the highlighted geopolitical tension in the Middle East and also very aggressive central bank purchases. Therefore, we raised our average selling price assumption by around 7%, from 2,900 to 3,100 US dollar per ounce, supported by the bullish momentum. And CNMC is also well positioned to benefit from the rising gold price as they sell gold at the spot rate. Yeah, so they are able to fully capture the upside. Last but not least, we also foresee increasing contribution from the byproducts, such as the non-gold metals like zinc, silver, and lead. We foresee them to increase by production to increase by 50% year on year in FY25. Yeah, so the contribution from the non-gold metals, it was around 33% of the total revenue, and we expect it to increase to around 34% this year. So we raised our FY25 PATMI forecast by 27% to 22.7 million, with dividend payout ratio maintained at a minimum rate of 40%, which will translate into dividend yield of 5.5%. We anticipate potential upside to come from the windfall profit, which could further enhance the shareholder value. And CNMC is trading at FY25 PE of 7.3 times and EV over EBITDA of 2.4 times. And moving on to Singapore Air Transportation Monthly. So in June 25, aviation sector saw pretty positive performance. And SIA Engineering was the top performer. It gained 29.3%. And SIA saw some downward pressure due to the tragic crash of Air India and also geopolitical tension in the Middle East, and which caused rising jet fuel price. And in May 25, SIA posted a 3.1 year-on-year rise in passenger traffic, which was outpacing the 2.8% increase in passenger capacity, leading to a 0.3 percentage point improvement in passenger load factor. And cargo continued to shine. The volume climbed by 4.2% year-on-year, exceeding the 2.9% growth in capacity on the back of the the continuous front-loading activity. And some update on the exit of Jetstar Asia. We do believe the exit of Jetstar Asia is a net positive for Scoot, as traffic will be redirected to Scoot, since it has been long operating under the break-even load factor of 91% for the past year. Yeah, so we expect more traffic to be injected and also yield to improve gradually, since Jetstar Asia currently operates 180 weekly flights at Changi Airport, which is representing around 3% of the airport's total traffic. And to fill in the gap, Scoot plans to launch several new services to Japan, Indonesia, and also Malaysia. Yeah, so this is pending regulatory approval in August. Yeah, and some outlook for the three countries we currently cover. For SIA, we do not expect any material cost to rise from the incident of Air India, as majority of the costs will be covered by airline insurance. And even though like SIA currently holds 25% of the interest in Air India, and they also posted a record revenue in FY25, we still expect some lost contribution from the associates. However, the recent share price performance is likely to be mitigated by the 30 cents dividend, which the ex-dividend date will be on 15 August, if I remember correctly. And for sets, there's around 5% of the group's revenue, which is contributed by the e-commerce from China to the US. And we do expect this to be impacted by the removal of the de minimis exemption. However, there's roughly like 7% of the order was canceled for the US cargo side, but the volume has been made up by the other cargo from like China to Europe, also China to Middle East, and we believe SES is well positioned to capture the shifting global supply chain. And for CAO, international air traffic surged by 32% year to date in April 25, So we do expect profit from associates, Shanghai Pudong International Airport, to grow at least by around 12% in FY25. Yeah, that's all for me. I'll hand over to Ding for Phillip Marco update.
Thanks, Mel. Yeah, good morning, everyone. So I'll give an update of some of the highlights that took place for the June FOMC meeting last week. So basically, interest rates were unchanged at 4.25 to 4.5%, in line with market expectations, kept unchanged since December last year. So the first key point is that the dot plot, which is released on a quarterly basis, still points towards 2 rate cuts later this year, despite Powell himself saying that no one holds this with a great deal of conviction. However, something to take note was that there was wide dispersion among the Fed officials themselves, and the median was held at 2 cuts by only one single dot. So in comparison with the March dot plot, seven participants saw no rate cuts this year, up from 4 in March, and about 8 participants saw 2 rate cuts this year, down from 9 in March. And second point was that they expected lower future rate cuts. So in 2026, the median Fed funds projection increased to 3.6%, up from 3.4% in March. And for 2027, that increased to 3.4% compared to 3.1% in March. So if you look at in terms of the figure in this slide, we actually see the average lines actually shifted upwards in the June meeting compared to the March meeting. Yeah, next slide. Third one was that from the summary of economic projections, SEP, we noted further stagflationary pressures projected by the Fed officials. So first one was that real GDP for this year, they projected a decrease of 0.3%, decrease from the March meeting, so it's revised to 1.4%. For PEC inflation, it was revised upwards by 0.3% to 3%. And then for unemployment outlook, you also saw a slight revision of 0.1% higher to 4.5%. Similar revisions were also made for 2026 and 2027. And fourth point was that some of the notable changes from the latest FOMC statement compared to the May meeting was that they said that the economic outlook has diminished but remains elevated from the increase further. And also a line stating that risk of higher unemployment and higher inflation have risen was also removed. Fed Chair Powell also added that the uncertainty about the economy peaked in April during the Liberation Day has come down afterwards. And the last point was that Powell himself reiterated his wait-and-see approach from May. So during a press conference, he said that there was more time to wait for clarity, and they will make a smarter decision if they wait a couple more months. And he expects that core inflation is expected to move up, and they expect to see more of that in the summer as it takes time for the tariffs to work their way to the consumer. So near-term inflation expectations have increased. However, in terms of the unemployment, in terms of the labor market, they feel that unemployment has continued to stay low in a narrow range with consistent with maximum unemployment. Next slide. So overall, in terms of outlook, Powell himself struck a dovish tone with expectation of 2 rate cuts still remaining in place despite the revisions to the inflation and growth forecasts. He himself also ruled out a rate hike at the base case during the press conference. As the SEP also notably showed the outlook has turned more stagflationary, and during the press conference, he focused more on the inflation that's coming from tariffs over the labor market conditions. And given that current economic data is insufficient for the Feds to adjust rates yet, he said that ultimately the impact of tariffs, depending on the ultimate level, will likely determine the window the Fed will start cutting rates in this year, which is expected to be in September, should inflation readings continue to remain benign in the near term. Next slide. Yeah, so I'll move on to some of the technicals. First one is on the S&P 500. So since the chart broke down the rising wedge formation last week is just trading sideways, so it was down 0.1% for the week. So it continued to hold at a 5,970 level. However, this week we see a decisive breakdown of that. We are likely to see some further downside towards the next support, somewhere closer to 5,850. So overall, for now, resistance likely to be at 5,970 to 6,030. Our support is likely to be at 5,760 to 5,870 area. Next slide. Next one, we have a technical buy for Supermicro Computer SMCI at $44.42. Take profit levels at $5.63 with a stop loss at $40. Last close was $45.32. So looking in terms of chart price action, has been range bound between like $39 to $44 since middle of May. However, it continued to remain above the previous range resistance, which was around $39 during the April period. So still holding well, and if price breaks above this $44 level, this prolonged consolidation where MACD is showing an increased momentum over time, holding above the zero line, we could see some further upside to test these previous resistance levels. Next slide. Yeah, so in summary of the trade initiator is currently in progress and it's up about 2%. So that's all from me. I'll hand over time to Paul to give an update on ThaiBev. Thanks.
Yeah, thanks, Zane. So move on to ThaiBev. So ThaiBev, every year they have this annual information. You go back to the title. Every year they have annual information meeting where they will have a briefing with shareholders and also a separate one with analysts. So these are the key highlights. I guess the environment is challenging, but they are coping with it. Next slide. Yeah, so in terms of the highlights, the two key areas for ThaiBev is spirits. Of course, it accounts for almost 80% of their profits. So the focus was on the decline in volumes in the first half was down about 1.4 or 1.5%. They mentioned that the decline in volumes was due to economic conditions. But something new was that the white spirits, for spirits in Thailand, there are basically two, there's white and brown. So for white spirits, they are facing some competition from the local producers. And this may increase because there's a regulation now in Thailand whereby they are opening up the brewing market to the small operators. Yeah, because it used to be controlled. So now it's subject to certain paid-up capital, certain types of machines, quality, then safety purposes, then you can actually open up your own brewery in Thailand now. The other part is brown spirits, but for that they are still the dominant. I mean, even they're like 90%. So for that, they mentioned harder for competitors to come in because of the unique taste and brewing technology. On beer, they're doing well in Thailand. According to them, they said that Chang has become the #1 beer. I mean, I can't verify this, but this is what they said. They have like 1.5 percentage points more market share than the near second competitor. What they have done is they perform well in events, home consumption, and of course, attracting the younger generation to beer. But the other thing for beer would be, I think in the news last week was the higher alcohol tax in Vietnam. So the headline news was actually quite severe. I think the alcohol tax will rise from 65% to 90% by 2031. The first increase would rise 5% in 2027. The impact on beer prices, they mentioned, was only around 2%. Whatever increase, they will just pass it on. So even if we take on the full 90%, I think beer prices will probably increase maybe 12-15%. Yeah. So and in general, in the medium term, I mean, alcohol consumption tend to be really price inelastic. So we don't think it would dent volumes that much. The first rise only 2027. So in terms of the outlook, a lot of the discussions, at least among the shareholders, was about the beer co. So they just said that the listing plan has not changed. They still want to do it, but they kind of implied that the current market environment doesn't make sense to list. They can't get the valuation, so they can't justify to shareholders to go and list now. I mean, they didn't explicitly say, but it's kind of implied. The other outlook is, of course, we also saw the news, a bit more political turmoil in Thailand. So for them, they said that consumer sentiment is, I mean, I guess quite used to all this political strife and not impacted. Probably some cross-border trade will be impacted. I think that we just saw in the news this morning. But they said that the one positive is that there's upside in gross margins because of falling molasses or sugar price, malt, and also aluminium. So in terms of our recommendation, we maintain our forecast. We didn't change on target price, but we are upgrading because the share price is big. We think the share price is underperformed due to a slew of negative news. I mean, we have the tariff concerns on Thailand. So the share price is down 18% this year. Regulatory changes, not just in Thailand, but also in Vietnam with the increase in tax, new drunk driving rules. And of course, recently, political uncertainty. But we do find the valuations attractive. It's almost like 9 times PE, probably at current price, and also yield of almost 6% for a dominant food and beverage operator. And also, of course, they are in the faster growing Southeast Asian market. One other point to highlight is the F&N listing that was asked. Do they need to keep listed? I think at least they mentioned that they prefer to have a pure play entity or listed entity in each of their respective businesses. I mean, all this can change, but at least in the meeting, this is what they said. There are a lot more other bullet points in the report. I mean, feel free to go through it. Next slide. So yeah, this is just an illustration of the cost. So they mentioned that during the pandemic, as can be reflected by the chart, they've been hit by much higher raw material costs. So you notice on the chart, when the pandemic happened, the one that went up the most from the 2019 was both sugar and aluminium. Aluminium surge. Aluminium now has moved sideways at least, then it rose, but then now coming down 2025. But sugar shot up, then consolidated, then shot back up again. So which is actually molasses, which is used in their spirits business. So and now it's at least trending down. So this will help them improve gross margins. Of course, the raw material price is lower, but no sales is also lower. So if you notice, beer and liquor consumption based on the industry stats, it's actually trending down lower. Next slide. So I'll do our usual macro. So for macro, actually most of the data points coming out from Singapore has been weaker, except property. So arrivals, actually it has bounced back up to 7, but I think year to date is still down 2.3. But I guess there's a nice bump here, 7%. Recovery driven by Chinese arrivals bouncing back up. RMC, which is ready mixed concrete, used by Pan United and also Hong Leong Asia. So that's also trending quite weak. I think down up only 1.4%. Singapore exports is also weak. The first decline in 7 months. Electronics also kind of deteriorated quite sharply. The one positive has been the new home sales. So new home sales in May was up 40%, even though there was actually no launches in May due to the elections. Yeah, of course this is slower than the 600 in April. In the US, no real signs of any major slowdown. I think the loans is still strong. Although unemployment claims is the highest levels but it's just trending up slightly. Next slide. So in terms of our tactical views, which we issued our weekly strategy. So of course the highlight is on the US attacking Iran. So I mean the key debating point now is will Iran close the Straits of Hormuz? For us, we don't think so. Firstly, 80% of all the oil, which is around 20 million barrels of oil per day that goes past the straits, most of it goes to Asia. So shutting it down, you actually don't really hurt Israel or US. You actually hurt your customers. And I guess you make more enemies. And if you look at the straits, most of it is actually in Omani waters. So if you attack that, you also make the other Gulf nations kind of angry at you. Of course, they are threatened. The third point is Iran has threatened to close the straits. So they've been threatening this since 1980. But of course, the other counter argument is that they never been attacked. So yeah, so that one is more like a neutral. So in conclusion, we are not expecting any runaway oil prices because partly also demand is still sluggish globally, especially in China. Inventories are high, and there's large spare capacity in OPEC. So almost 5 million spare. So OPEC might meet again end of this month, and they might probably raise production again. Even before the attack, they already mentioned they want to raise production. But if you're looking for beneficiaries, it even includes capital because of the REITco, the 4 billion REITco assets. High oil prices means they're easier for them to sell. Of course, you got Citra, Mako, and also Pacific Radiance. One final point is the FOMC meeting was a non-event, of course. The Fed is just sitting down, just waiting for some inflation to come because of the tariffs. And even the dot plots, Powell mentioned that there's not much conviction on these dot plots. So I'm not sure what was the purpose of the meeting anyway, but all he said was a lot of uncertainty. I mean, 14 times if you do a count. Yeah, so I'm not sure, so it's probably the waste of time meeting, but anyway, he's just waiting for inflation to rise, like what Zain mentioned. In terms of the events, these are some of the events, but I guess the macro one would be the core inflation coming out on 27 on Friday. We also have Capital Infrastructure Trust tomorrow. Those who have been asking us a lot on Capital Infrastructure Trust, feel free to dial in. It's open to everyone. Then on this Saturday, we will have our usual quarterly strategy. It's a whole day event, and we will have US and then we have Singapore in selected time slots. Before that, there'll be a REIT panel for those who are interested at 9:30 on Saturday. Just go to our website here, and just feel free to sign up for the webinar. Yeah, the physical is closed. Closed already. Yeah. Next slide. So this is just a illustration of the arrival. So a bit soft, I think, the tourism for Singapore this year after such a strong bounce last 2-3 years. Ready mix, I think we mentioned. Next slide. I think this should be the last one. Okay. Oh yeah, this is just the production of all the big. So this US production, it seems to be stalling. Iran benefited the last few years under Biden, I guess. But you notice that Saudi Arabian production has been down from 11 to 9 million. So I think Saudi can really, they can always raise production. Not always, but they have an option to raise production to cover any shortfall in Iran. So to keep the oil market balance. The chart on the right is nothing much. We only use this to just track inventory to sales, and generally, inventory is generally stable, so it kind of moves along with oil prices. So there's nothing unusual here. Thanks, everyone. I think you can move on to Q&A.
Yes, I'll take the AI question in the chat. Do you have any concrete example of how AI have added value to companies and share prices? I guess if you take a look at Amazon, so AWS revenue when they started out in 2021, it only accounts for 6% of the entire revenue of the company, and right now it accounts for around 20%. So if you look at their CAGR for the 3 years, it's around 54%. Now AWS is already a multi-billion-dollar AI revenue run rate. So they're still heavily investing on that. They're investing roughly 100 billion for their FY25 on CapEx, and most of it is going to AI as well. So if you really look at how it add value to the share price, starting from the beginning of 2023 to end 24, their share price surged around over 160%. And that is mainly fueled by their AI optimism. And look at 2024 alone, it climbed 44%. And for them right now, the story is not ending. It's still growing at a very fast run rate. And for them, it's more of a story of they don't want to underspend. So because for technology stuff, once you fall behind, you're really going to lose your compatibility. So for them, they rather overspend, and they're seeing a lot of healthy demand coming in. So yeah, I hope that answers your question. Maybe I'll pass it to Serena. Maybe you can talk about other companies.
I'll take the same questions for Meta and Alphabet as well. For Meta, I mean they focus on a lot of ad recommendation systems. So they actually has been testing the recommendation model for Reels, and the first one they can already see there's an increased conversion rate by 5%. And besides that, the recommendation system actually, the better recommendation system actually allows the user to actually increase their time spent quite significantly on across their platform. It's 7% on Facebook, 6% on Instagram, and 35% on Threads. And then I mentioned it in my presentation. The revenue growth partly mainly is contributed by the increase of the advertising prices by 10%. That is also because of they do have a better recommendation system, and therefore the advertiser demand also increase. So this is why the prices increase as well. And for Alphabet, for both their main segments, AI added quite a lot of value on it. The first one is because there are a lot of enterprise that they are focusing on AI to power their technology. So this is why they double down a lot of their cloud spending. And this Alphabet 28% year-on-year growth for the last quarter is not because and it's not just actually the demand is still very strong. The 28%, it does not include that because of the supply constraint. So once they remove that barrier, it is possible that it has a stronger growth. And for the ad segment, it's similar with the Meta as well. They implement AI, they integrate into their recommendation system so that there are more demand for the advertiser because they can actually better target all the audience. So once there are more demand, they actually have to bid on the ad. So this is why that it can boost the ad pricing increase a little bit. Yeah. If there's any other MAG-7 questions. I don't think so. So maybe I'll pass the time to my other colleagues to answer some of the questions. Thanks very much.
Yeah, thanks, Serena. Yeah. So for the rest, I think Nvidia, yeah, it's really only because of like AI and the coming of AI. That's why they are what they are right now. So I don't think I have to say much about that. I think it's more on the other the other companies. If you look at Microsoft, yeah, the analyst not here, he's on leave today, but I think I can just cover him a bit. If you look at Microsoft, I think it will be mainly coming from the Azure, right? So they have seen quite extraordinary growth in Azure, and this is their pure AI. The only way that we can tell how well is it being monetized, right? Where we can see 35% year-on-year growth. There's also other aspects of Microsoft, like the Copilot, which is introduced into a lot of your. If you use Microsoft, you realize that Copilot is really into almost every aspect of your Microsoft Office, right? From Word to PowerPoint to Excel. So I think that is a bit hard to quantify because these are considered enhancement. There's no direct, I would say, link to how much it has, improved the earnings or even the share price, right? So apart from that, I think the only one that we can look at is the Azure, where we are seeing good growth. Another counter would be Adobe. So Adobe, they also don't, they did implement AI quite some time ago, I think a year or two ago, into their photo editing apps, where we see it improving the workflow for a customer and also, making it easier for them to complete the things that they want to do, right? And I think the most beneficial for Adobe would be the AI generative, right? Where it sort of complements the user and the whole workflow. But now that they have launched this new Firefly product, I think they're anticipating that they will have I think they will double their AI revenue, which is what they call it, to about $250 million USD by the end of 2025, right? FY25. So it's still very small because a lot of the AI that they are doing, right, is a lot of enhancements into their products. If you look at Photoshop, Lightroom, it's a lot of enhancements. So there's no way to quantify how much is that going to improve, right? I think the only one they can see now is Firefly as well as their Acrobat AI assistant. So those are the two that the customer has to choose to pay before they can utilize this solely this AI product, right? So I think those two are the only ones. So it's around 250 million by end of FY25. So it's still quite small, around 1% of their full revenue, but at least there is some way where they are actually trying to monetize AI and to show both the investors and shareholders that we have a way to monetize it. I think for Tesla wise, there isn't really much. I think the only thing that they have in the pipeline would be the full self-driving, right, and the robotaxi. So that's utilizing AI as well. But then again, it's a bit hard to to quantify because it's not even fully it's not even come out, it's launched fully yet, right? It's still in the test launch or pilot launch. Yeah, so if that happens, then we could see a huge improvement. But I think, you know, there are a lot of headwinds for Tesla, which I mentioned earlier. Yeah, someone asked, you know, I think Tesla is worth badly hit because of attention seeker Elon Musk. Yeah, that's true. And there's one question here. Any outlook on Tesla? Yeah, I did say, I think I did mention earlier the outlook on Tesla. So do we expect drivers for share price to rebound or to tank further? Yeah, so the drivers, there's really only two drivers, right? Actually, three drivers, I would say. Yeah, the first one is Elon Musk finally coming back, right? That is a driver. But then again, I think it has been priced in already, right? The moment he came back or he announced that he's coming back, the share price, you know, ran up, I think by about 20%, 30%. So that's really priced in. I think the second one would be the pilot launch of the robo-taxi, right, in Austin, Texas. Then again, it's still a pilot launch, but it will spell out how well they have prepared for it, right? Whether or not it's just a rush launch or they have done a good job, right? And if they did a good job, then I think it'll be very smooth and we could see it being rolled out more in the US. So that would be one of the drivers. And the last one would be the reception to the new Model Y, which I think they're officially launching in June, right? So they have launched it, but we only get the figures for the sales coming in maybe mid-July or August. And that's where we can see whether or not the reason why the deliveries were so poor the last few months was because people were holding out, waiting to buy the new one, right? It's like if a new iPhone is coming out, you won't buy iPhone 16 if iPhone 17 is coming out. Yeah, so we have to wait and see if that is the case, or if, you know, deliveries continue to decline, then, you know, it could mean that there was actually no hype, right, with the new model at all. Yeah, so but the headwinds are vast, right? The fact that they are losing a lot of market share to the Chinese EV makers now, not just in, you know, the Chinese home base in China, but also in Europe, which I mentioned earlier. They're also continuously losing market share. I think it's a lot of to do with the price, where they cannot compete on price, right? And also, you know, if you look at, I mean, in Singapore, it's quite common, right? BYD, you know, and a lot of the Chinese XPeng. You will look and then you realize that in fact, the Chinese EV cars, they might even be built better, right? There's more features and everything. The only difference is the name, right? If you look at XPeng cars, I was quite surprised when I saw the XPengs. I think the newer ones, they look almost exactly the same as a Model Y, right? It might even look better, the interior. So I think that's the difference with Tesla, where, you know, they have to identify what is their selling point, you know, and try to branch away from the Chinese players, because they are able to compete on price, they're able to compete on features, you know, and everything else. Yeah, so but I do believe that the share price is currently quite inflated, so we do have a sell and a target price of $200 for Tesla. Yeah, do we expect tech stocks, especially MAG-7, to retreat in view of the US bombing? I don't think they will retreat much, at least in view of the US bombing. It's quite far away, and also, you know, a lot of of course, if there's it's quite what their business model and everything, it doesn't really have any interaction with the Iran and the US bombing. Yeah, so I don't think there will be much retreat. Okay, I'll go to the Singapore ones now, because I think there's a few Singapore ones for me, at least, or at least one. Yeah, so yeah, one or two. Hold on, let me try to find it. Yeah, okay, there's one of the banks. Thoughts on Singapore banks going forward in view of the expanding Middle East wars? Do we expect any Fed interest rates cuts now, at all now, sorry, with the latest US involvement in the Iran conflict? If interest rates stay out, this should benefit the banks with better net interest margins, net interest income. Yeah, that's a good question. Yeah, so I think the main difference for the banks and what will be impacting them will be the Fed rate cuts. So I think, you know, as Paul also did mention earlier, they're only expecting around 2 rate cuts now at the end of the year. So if the interest rates stay high, right, is this benefiting the banks with better NIMs and net interest income? Yeah, technically it should, right? But then again, you know, interest rates at least rate cuts and rate hikes are double-edged swords for the banks. right? So on one hand, it'll be good if the rates stay higher for longer because the loan yields will be better, right? And the banks will be able to earn more, right? The spread, you would think. But then again, on the other hand, right, the loans growth would also get a hit because if the rates remain too high, consumer demand and the company or the SMEs will not take up as much loans as they want because firstly it's too costly for them. Right? We expect that housing loans will still remain strong because if you're going to buy a house, you would have to use a housing loan. So, but I think the manufacturing segment might be hit slightly, as they pull back a bit. But what the banks are doing to combat this is that they are lowering their funding costs. So if I believe most of the people here have some form of current account with a local bank, right? And you will also know that they are starting to cut a lot of their interest rates on their flagship accounts, right? Like the UOB account, one account, the DBS multiplier, and also the OCBC 360. So they are beginning to cut, and that will sort of help to buffer the margin spread. Because then the funding cost, which is a cost, will decline, and then the top line will maybe decline slightly. So that will help to give that buffer to net interest margins. Not only that, we are also seeing the FD rates also start to fall quite drastically. Right now, I think you'll be lucky if you can get even 2%, right? I think it's 1.8 or 1.9%. Not just the local banks, digital banks also have started to all cut, right? So almost across the market, everyone has cut their fixed deposit rates. So that's a good, I would say it's a good indicator it's a good positive for the banks because then a lot of the customers like you and myself, right, wouldn't want to put it back into a fixed deposit because it's so low. So we just put it back into your current account, right, and just leave it there. And for the banks, the current account is very valuable because it represents almost zero funding cost, right? Or is as good as free deposits for them. So we have seen also that funding that CASA or current account savings accounts ratio has continued to increase in the past few months. As a lot of these high interest fixed deposits start to mature, and then they get placed. They don't get placed back into another fixed deposit. They just get placed into current account. So we are seeing this creeping up. It has been around just below 19 for the longest time, and then now it has like 19.2, 19.3%. So the higher it is, the more beneficial it is for the banks. So I think overall, the higher rates might hit their loan growth a bit, right? But I think the banks are able to manage it by lowering their funding costs and keep the net interest margins relatively stable. And also they put a lot of these excess deposits into sort of longer tenure interest earning assets. So once this rolls over, that will be beneficial to the net interest income as well. Yeah, sorry, it's just a bit of a long about way to answer that question. Let me see if I have any more. Oh yeah, I think there's one more on the SGX. Yeah, I'll look on SGX and ST Engineering. I'll leave the ST Engineering one there. For second half, do you expect further upsides or reversions to anytime soon? Yeah, so for SGX, it's very dependent on the volumes, right? But volumes have been very strong. But I think the problem is that the volumes spiked up in April, right? In April, sorry, right? In March, April, where it spiked up 30-40% kind of increase in volumes. And then in May, it sort of dipped down a bit, as volatility stabilized. So the share price will follow a bit similarly to how volumes are trending. So if volumes are good, we could see the stock price go up. And now, Trump doing if Trump does even more things, right, then we could see volatility further increase. So it's very dependent on what's happening with the volatility. Yeah, I think that's for SGX. Yeah, there's one here on the sorry, someone said you could actually mistake Xpeng SUV for Porsche Macan SUV. Yeah, very true. Yeah, I saw it the day. I had to take a second glance. Yeah, so that shows how fast the Chinese EV makers, right, are not just replicating the Tesla, but they're actually becoming now. They look even better than Teslas, in my opinion, at least. Yeah. Okay, I think that's all for me. Let me hand it over to the rest of my colleagues. Thanks.
Hi, thanks, Glenn. I'll take the Zixing question. I can't understand Zixing, like to know the rationale or investment thesis behind Zixing. So basically, they are a sweet potato operator. So they cultivate sweet potato in China, Lincheng, and they also like do sweet potato seedling. Some of them for their own usage. The other will just sell it to other parties. Yeah, so revenue will come from fresh sweet potato products, processed sweet potato products like the snacks, like packed sweet potato, and also like seedlings. And they have another new revenue stream, which is the fermented sweet potato, like the animal feed. Yeah, so this is currently a very small portion of the total revenue, but we do expect potential to come from this side. And for investment thesis, is we like Zixing mainly because of the pet meat potential. So pet meat surged by more than 200% in FY25, which is the last financial year. Yeah, so we forecast another at least like a 35% increase in pet meat in this financial year. So this will be driven by the expanding capacity in the cold storage facility, which is scheduled to be completed by second half 26. And also, they are building another factory for the processed sweet potato products. Yeah, so this will also be completed by first half 25. And so they plan to introduce some higher margin products for the processed sweet potato. Yeah, so we expect margin to expand for this revenue segment. And for the sweet potato seedling, Zixing plan to expand the total cultivatable area by double. So they already double from in the previous financial year. And in the current financial year, they plan to double it again. So we expect revenue to follow the increasing capacity, which will also be doubled. Yeah, that's pretty much all the catalysts. Yeah, hope it answers your question. And yeah, and for the animal feed part, so they used to do it by themselves. Now they outsource to the third party operator. Yeah, the third party operator will expand their capacity from second half 26 onwards. Yeah, so that's why we expect the sales for animal feed also to increase and contributing by around like 900,000 RMB in revenue for the full year FY26. Yeah, hope it answers your question. And there's a question on Lendlease privatization. Any chance like Lendlease will go privatization too? We don't think Lendlease will go privatization in the near term. Firstly, because like it has higher free float compared to like other REITs. And even though it's currently trading at around like 0.7 times price to NAV, but pre-COVID they used to trade at around 1.1 to 1.2 times price to NAV. Yeah, so the current overhang on their share price is pretty much like because of the high borrowing costs and also the pretty low interest rate coverage ratio, which is at 2.5 times, which is just nice at the MAS regulatory threshold. But we do expect it to improve from next quarter onwards as the new GEM office like rental reversion, which is around like more than 5%, will kick in from next quarter onwards. Yeah, so with higher cash flow from this part, their interest coverage ratio will also improve. Yeah, hope it answers your question. I'll hand over to the rest of my colleagues. Thank you.
Yeah, there's one for me on CDL Hospitality Trust. Yeah, the question is together with Simvet, Mac, and CITL, but I'll just cover. I'll take the CDLHT. Yes, so for CDLHT, basically, they are a strong proxy to Singapore's hospitality. with the assets slightly in the higher tier, so we saw RevPAR not performing so well as expected for Singapore over the first quarter. But for them, their capital management, because they are hedged at a very low percentage, about 34% only, so they are primed to benefit from more interest rate cuts. So we saw their interest also it declined quite significantly, 0.4% if I got that right for the first quarter. Yeah, so I think going forward also, they benefit from more cuts, and their RevPAR operationally wise, we think it likely to be flat to mount a slight negative for Singapore for their assets as well. So yeah, but for them, the bottom line is likely to be the weakness from the RevPAR will likely be offset by the interest savings for them. Yep. So that is the outlook I have for CDRHT. Yeah. Thanks. I'll leave it to the rest of my colleagues.
Yeah, thanks, Darren. So let me just try to address some update on the fundamentals of CIFMAC. I don't know what CITL, but and also the TA. So for CIFMAC, I think the interesting angle for CIFMAC is the whole increase in defense spending. So they used to get this petrol vessel contract, but I think disappointingly, I think it was dialed back. But right now, with Australia looking to increase the whole defense budget again, so I think that's why the interest have come back to CIFMAC. With flight to safe haven, besides gold, do you expect higher demand for and also for long-term US bonds and long-term yields to drop? Yeah, I think bonds has a place right now. I think that's why you don't. Our view is you don't see the big sell-off in bonds, even though you got all these worries about the US budget deficit, which this has been a worry for almost, I don't know, 20 years. But I think the one thing is that people still expect the Fed to cut rates, especially when you're going to when Powell's term ends in end of May. So that's why I think that's what's holding back any collapse, any collapse in bond prices. So I think that is becoming a bit of a safe haven. We also noticed since the attack, the US dollar has started to creep up a little bit. So there is a bit of flight back to the US as a safe haven. So for us, I think long-term bonds is also a place for a safe haven. I mean, that's our own view. Apart from gold, outlook on SGX and ST Engineering for second half, do you expect further upside reversion? I'll leave SGX to Glenn, but for ST Engineering, I think the thematic is strong. The earnings will, because the stock's really trading at 30 plus times, the earnings will still be healthy. We are looking at maybe 15-20% kind of earnings growth. But the thematic is still strong. I think because as we have all seen, the attack on the US on Iran also symbolizes that the whole landscape where you need to justify attack, the need for rules-based, where you need to get some UN clearing before you attack another country no longer happens. And now is the jungle rules like we mentioned last week. Whoever has the stronger defense wins. So I think the underlying theme is that there's going to be a major arms race globally after we've seen all these events. Yeah, there's no rules or no rules of engagement. I saw the jungle rules. So who has the most weapons win? So I think there's this big arms race, and that's why ST Engineering even at 30 times, I think there's still some upside to it because it's just going to be a huge valuation expansion. Your fundamental view on Wilmar and Keppel Corp, please. So for Wilmar, I think the better way to play, I think all the plantations have this big overhang. I think we mentioned this before, that the Indonesian authorities is looking at everyone's plantation to either deem them as illegal and either fine you or confiscate, or most likely just fine. So you just have to go through this whole overhang. And of course, Wilmar, the problem is also the big consumer spending. For Keppel Corp, we are, I think among all the GLCs, the big ones, I think a lot of the GLCs have run. We've seen ST Engineering run, Singtel run, Sembcorp to a certain extent. The one that's a bit laggard is Keppel. We are probably the most positive on is on Keppel. because we think operationally things will get stronger in the second half. The three things would be there's the opening of the Keppel South Tower. The whole building was under construction, so that will contribute. Then you got the submarine cables will also complete by this year. Then by next year you will have the new Keppel Sakra Cogen plant. So that will also contribute. So operationally things will look stronger in the next 12 months. And then you have the in the background the continuing disposal of the, I think slip my mind again, sorry, but the 10 billion of asset monetization that they plan to do. So I think probably that would be Keppel Corp. That's why we think is our preferred pick among all the large caps, at least for me. The impact on Middle East, we don't really see. Maybe it could any impact will be on LNG because Sembcorp and Keppel use a lot of LNG. But we don't see any direct or even indirect impact will be through higher LNG prices. But most of these are already back to back. They don't really do much spot purchases. Ironically, it might maybe help them a little bit because if LNG prices climb up, then our customers might be more in tune towards kind of locking in longer term power contracts or electricity contracts. Again, we can only speculate this. With the chaos and wars going on, tariffs and sticky rates, what are your three top stock picks? I think for us would be I think we still like the banks, I think especially DBS, maybe Keppel Corp. Yeah, and one of the REITs. So for us, this will be the areas that we like. Even the other one, of course, Stonebank, which is always like that. So these are some of the REITs, some of our three top stock picks will be like the DBS Keppel Corp. Yeah, in view of the recent happenings, what's the outlook for US dollar bond treasury yield goal going forward? Well, okay, so for us, our general view is that, of course, most people don't agree, but our general view is that rates will come down because the Fed will become more politicized, and with Donald Trump pushing for it, I think eventually rates will come down, and then this will push up bond yields. US dollar won't get impacted in the beginning because lower interest rates. I'm sorry, it's a very long story, but anyway, lower interest rates actually help the US budget position. So actually, it might help the US dollar. US dollar might get the big sell down only if you see inflation coming in. Yeah, but we will talk about this in our Singapore strategy. We have this roadmap where we think that's before we hit the bear market. But yeah, I think gold will continue to stay elevated. How much further? I really not sure because it's run up so much. Yeah. What's the outlook for Wilmar after recent news? Is this still covered by Paul? How come another wrong call on this? Yeah. Don't worry, man. There's always going to be a lot of wrong calls. We don't really cover Wilmar. It was I don't think we ever covered Wilmar, but I mean when people ask us, this is just our general view and observation because we attend their analyst briefings. But it was difficult. I mean, I don't think anybody knew the Indonesian government would go around taking people's land. But I think they did highlight that in the recent analyst briefing. So that was the warning. For us, if you want to go into palm oil, it's better to just go direct to the palm oil plantation companies, which I think palm oil prices has actually rebounded. But rather than go through Wilmar, because you're going to get the downside risk from China, so better to just play pure plantation companies like First Resources and so forth. Yeah. Sets, I'll leave it to any coverage on Singtel has been on the bull run. Wonder if I should buy. I cover Singtel. We are a bit more hesitant now because the yields are not so attractive really. I think it's like hitting 5%. And also the big run up in Singtel, we don't have the chart here, but it was mainly because of the spike in Bharti Airtel's valuations. So that's why in the very near term, I mean, we had a buy call for a few years, but I think right now we are a bit more hesitant, a bit more because that valuation gap with Bharti. So if you look at the chart, Bharti, their stake in Bharti even exceeded the whole Singtel market cap at one point. Since then, of course, Singtel share price has overrun it. So we think it might move sideways more in the very near term. That's my own thoughts. Our preference is still Keppel Corp. But what's the impact on BRC and Pan United in the construction material going cheaper in the near future reported? It actually benefits them in the way. Most of the raw materials is passed through. Um, uh, because it's all adjusted. There is the BCA has an index on it. Of course, it may not be 1-to-1, but most of the material cost is actually passed through, and so it doesn't really impact them. And most of these building material companies, they don't want to. They don't want to take any position and try to predict raw material price. So that's why generally it's a pass-through mechanism. Of course, there could be accounting-wise, there could be a bit of lag because of the but most of it pass through. Yeah. How much will the latest graph impact? I think the worst case is just a fine. I don't think the authorities want to take back the land. It's most likely a fine, and it's a big one. I think the amount there was quoted. There was almost 900 million Sing dollar, if I'm not mistaken. So that's the worst case scenario. Yeah. Although this is a deposit, but I mean, once you deposit, I'm not sure. I don't know how to comment on it, but that is the worst case scenario. Yeah. But I think we did talked about this. I think like 1-2 months ago. But of course, this time around it was really highlighted the risk. But this time around, they actually had to put money with the government. Yeah. And other plantation companies are not immune to this. Do you see StarHub merging with M1 since that the call is wrong again? Oh yeah. The StarHub, the merger. We still believe the merger will happen. I mean, it's all speculation, right? But it should be happening this year. It will. The better way to play this is through Keppel. I can't tell you the exact date. Even if I know, I can't tell you. But the merger will happen. I mean, because this is part of Keppel's monetization plan, and of course, what makes the merger happen is not so much either management's decision. I know they have a common parent, so we think ultimately it will be the common parent that will decide the merger. Yeah. We wouldn't play the merger between M1 and StarHub through StarHub. I think there might be a short-term bounce, but then that's not the way to play the merger because they have to take on all these additional costs, integration time, and then loss of market share. Typically, if they do this merger. Thanks. I think that's it for me. I think we can pass on to the rest.
Yeah, I think that's why I answered the SGX one already. So onto the if anyone else has, if not, I think Zane can do the TA.
Okay, thanks. Yeah, I'll just share my screen for the TA now. Yeah, so I think for first one is on Zixing. So I think we're seeing short-term weakness as price is last week mentioned below this 0.031, currently trading below some of the short-term moving averages as well. But I think we could see some rebound so at 0.028 maybe at that level, because previously it was a horizontal resistance level previously, and it's close to a 200-day moving average. So previously in April over here this year there was a bit of we tested this level before a bit of rebound took place. So over here I think 0.028 there might be some rebound from this level now. And for now resistance probably around 0.031 and above. Next question is on China Aviation Oil. Yeah, so for CO, I think recently price audio rebound further with a gap above this 85 cents level and just trading a bit sideways. So I think could see a bit of a consolidation with supports from the short-term moving averages probably around 86 cents to 87 cents level. Yeah, and then we'll see some consolidation, and then the next resistance level will probably will be around 90 cents. For Singtel, I think looks like just moving quite sideways, so still capped around $4, but price wise, I think still moving okay. Some support probably around 380 at the lowest. Then price is still overall making higher lows along the way. Yeah, so just a very prolonged consolidation, I guess. So still rather sideways. Next one is on REITs. Yeah, for REITs, I think today we tested this 23 cent swing high resistance. So we might see some sideways for now still. Yeah, actually price has been a bit sideways. So we're citing support for now, probably around 21.5 cents. Yeah, if we can break above this 23 cents level, we'll continue this rally towards 25 cents next. And for RH petrol gas, also some they're just moving sideways around 20.5 cents. Yeah, support is still coming from the term averages currently around 20 cents, as well as probably somewhere around 19 cents if it dips below that. So we might see some consolidation over here for now. There's also resistance around 21.5 cents level. Next, yeah. So I think it should be quite sideways for now. And next one, LHN. For LHN, I think probably moving in this upwards channel for now. So would see some kind of sideways over here for now, with support probably around 55 to 56 cents level. Yeah. Then resistance probably around above 59 cents. Yeah. Next question is a question on GSD, which is gold Sing dollars. Yeah, for this, I think overall it's still kept in this uptrend, very nice uptrend channel over here. Just a bit sideways, I guess, with price still facing resistance around $407. Then I think support for now, somewhere between 388 to about 395 this area. So we might still see some sideways for this GSD. Okay, next one is on Franken, UMS, and CSE Global. For Franken, I think still rather sideways. Price still can't break above this $1.17 area, and it's still holding around $1.11. So I think it will be quite sideways. Yeah, still just range trading. And for UMS, I think are gradually trending upwards, and price retesting this $1.17 previous resistance. So I think we'll probably find support around here, and I think rebound slightly towards the current resistance around $1.22 to $1.24 even. Yeah. Then CSE Global. Yeah, for CSE Global, I think they're still trending okay. Since breaking above this 47 cents level. Yeah, and I think probably just trending along the short-term moving averages. Probably 50 cents now is the support. Yeah. And next one, some of the TA for the CDL Hospitality Trust. I think for this, yeah, generally it's in a downtrend. It will be sideways for now. So I think we'll still remain 75.5 cents to about 78.5 cents. Yeah, unless there's a breakdown below 75.5 cents, then it might trend towards 72.5 cents. And SafeBank. Yeah, for this order, not much volume right now. Every day, so it still looks a bit sideways for now. Yeah, just probably nothing much. Right, just in a time range 85 cents to around 87 cents area for now. And CIT, I'm not sure what is that. Maybe you can read them in the chat. Thanks. Next one is on sets. And ODC. First one for sets. Yeah, I think price today retesting this level around $2.92 to about $2.96 this area. I think we might see some slight rebound from this level, but I think it's still rather weak right now since the breakdown of this $3.02 to $3.03 level. Yeah, so we might test the 5 MA, and it might find some resistance from there. And for Yansizang Shipbuilding, I think some weakness for now is price to be possibly breaking below this trend line support, and also price has been consolidating sideways between like 222 to about 232, and if you break up below 222, you might see some further weakness downwards, maybe towards somewhere like $2.13, $2.15 area. For Kappa, I think it's still trending well. It's just moving sideways still, and holding the short-term MAs over here. So I think for now here, we have some support around 728. Next support level downwards, which was this consolidation breakout, was around 716. So I think looks a bit sideways, but uptrend is still quite steady. For Triple DC REIT, it's also just moving a bit sideways. I still okay as it's holding this $2.25, $2.26 as support. Because these prior resistance, and for now, $2.33 around there is resistance. Yeah, so it looks a bit sideways for now. Okay, then moving on to some of the Hong Kong counters. So first up is Hang Seng Index. Yeah, so for Hang Seng Index, I think there's some short-term weakness as price is last Thursday, the price couldn't maintain this 23.7K level, this horizontal level, also below the 20-day MA. So we might see some weakness if it continues to stay below that, this 23.7K. Then next key support will be the recent swing low at the start of this month, somewhere closer to about 22.7K. And moving on to the other counters, Alibaba retesting this support around 108. Yeah, so we might see some consolidation around here, but I think still forming lower highs. So we might expect some resistance if it does rebound towards about 113 to 115 area. Yeah. Next one for Tencent, I think, yeah, moving a bit sideways. So probably could retest 490 for now as price it couldn't hold this 508 level, then just inching a bit lower downwards recently. Next one for JD. There looks to be a descending triangle, lower highs along the way, and multiple tests of the support at 123, 124. So yeah, we could see some continued weakness come in with resistance 129 perhaps. Yeah, then I think if there's a breakdown of this 122 level, we might see price test about the next support somewhere like 112 next. Okay, this one is for Baidu. Baidu also this 85, 86 level, previous support holding as out as resistance. So I think price trend dip a bit lower to retest this 79 level here again. Then you could see some sideways around there. And for AIA, I think still one of the better ones. They are still, I think, still holding up the upwards uptrend over here. Dip towards this 66 hold as a support. So I think you could see price rebound from here and maybe retest this 71, 70 to 73 resistance area. For PI insurance, I think still looks like a bit sideways with resistance probably around 48 onwards to 50, and support is just holding around 45, 46. So I think it should be quite sideways around here. SMIC, I think we could see some rebound. Price has been facing resistance around this downward resistance time, but today there's some strength, I think, spike the overall market is down, yeah, we could see some rebound towards maybe 43 to 44 area. Then we might see some sideways afterwards. And for 3191, this global ex-China semicon ETF, for this, I think it's facing resistance along this downwards resistance line. So that's probably around 40, around $40 right now. Support is holding around 39. So it's probably in a high range right now. There's needs to break above this level, then you could see some bounce towards 41 as the next resistance. Then the next one is China robotics AI ETF. Yeah. So overall, this is quite range bound, I guess. So over here, 44, somewhere like around $44, this level over here is the area of support. Yeah, so I think price could rebound from this, do a bounce from this level, but some resistance could come in around 47 in the short, for around $47 in the short term. So could just do some sideways trading for you. Okay, then there's a question on Bitcoin and Ethereum. For Bitcoin, I think we could see some rebound from this level. Overall, it's quite sideways since end of May. This level around 101K is a strong support. So we tested actually yesterday, then I think we could see some rebound from this level again. To then resistance for now probably 105K. Then for Ethereum, yeah, for Ethereum, I think for now recently there's a break. It was in the range around 2004 to about 2007, and recently there was on since Friday there was breakdown this support. Yeah, so I think we could see some weakness maybe to test this 2070, 2080 level for then before price to be a rebound from there. Then there's a question on the USD Sing dollar pair. So for USD, I think against Sing dollar, it has reached a level of support 1.28. I think it's this support level over here. And I think as Paul mentioned earlier just now, we've seen some USD picking out a little bit. Yeah, so today it's about 2.3%. So we could see, I think at this level 1.28 is a support that should hold. We should see some rebound in the short term towards 1.3, I think. 1.3 to 1.31, around this area. Okay, next question, SIA Engineering. So for SIA Engineering, I think it's probably trend following, but recently there's a bit some weakening in terms of the trend, where previously was trending along the 5-day MA. So yeah, so currently it's below the 5 and 10-day moving averages. Yeah, so we might see some consolidation start to take place, where probably 317 and above is a short-term resistance, and support could come in at around $3 to about $3.05 area. Yeah, so maybe we could see some consolidation for now. For Sheng Siong, it looks like a range bound. Yeah, so still resistance 188 holding, but looking better is the higher lows recently. So for now, probably support around 185. So for now, we might still see some consolidation, but if you can maintain the higher lows, then there could be a breakout this resistance in the future. And for CNMC Goldmine, yeah, for now it still looks quite range bound. So currently, I think 42 cents should be able to hold over here. So probably kept at 42 to 44.5 cents range for now. Okay, next one is on Samudra Shipping. Samudra, quite range bound, around 80 cents to 85 cents. So today testing the 80 cents level again, could see price hold over here. Then some yeah, some short-term resistance could be around 82 cents. We heard, I think yeah, pulling back from the strong resistance at 47 cents. Every time price comes to this level, there's a pullback. But positive thing is that there's higher lows every time. So could be respecting this our support line where I think price could find some support if it does test 42.5 cents to about 43.5 cents this area here. So could be quite near. Yeah, previously there was a horizontal level as well. So price could possibly rebound at this area if it does retest it. And for UOB Kay Hian, I think it looks like a bit of a sideways for now. Yeah. So it looks like just some consolidation where support will come in around 188 about there, and resistance is about 195 over here. So quite sideways. For the STI, for STI, I think some slight weakness since Thursday, Friday last week, where this short term our supply line was being broken. So I think we might see some weakness to test this next area of support around 3008 to 3840, this area, and the index might rebound again from this zone. Then for the three local banks, first one for DBS, I think we might see some rebound from this area around 43.30. There's some support previously over here, so we might see some rebound over here. Then resistance, short-term resistance will be somewhere around 44. Yeah, 44 to 44.45 area. And for UOB, there's since the breakdown of this 35 previously was consolidating above it, this has turned to be a resistance. So I think we might see some weakness in the short term view. It could possibly be test 34, where this will be likely a support could rebound from. And for OCBC, I think it's quite similar as well, since the breakdown of this $16, 1610 consolidation support, now testing this 1580. Yeah, so this is a support that it could rebound from. Okay, hi Lin, that's a good question. Yeah, for the TA calls, besides email, how is it conveyed to us? So I sent it through the Podium's TA Telegram group as well as the Podium 3 technical analysis community. Yeah, so I'll drop the links later. Yeah. And hi, there's a question on Oxley TA. For Oxley, I think there's a bit, the short-term momentum has dipped quite a bit. So previously price was trending along the 5 and 10-day moving averages. Then last week was quite range bound. So finding resistance is 0.093 onwards. And support was holding at 0.089, but there was a break today. So I think we might see some dip towards 0.084 perhaps. This level, then it might do a consolidation with 0.090 onwards as a resistance. So I think it could move a bit sideways in the short term. Then there's a TA for Alphabet. Yeah, for Alphabet, I think Friday there was a bit of sell down, about 3.8%. So retesting this channel support again. So over here, it'll be quite important to hold that 165 is also a key horizontal resistance previously that turned into a support over here. So we might see some rebound over here, but if it does breach this level, it could see it could test the next support level around 157. For Berkshire, I think it's continuing on the pullback. Yeah, since from 540. Yeah, so overall yeah, nothing much, just pulling back slowly. I think it could test some levels close to like 407, somewhere close to 470 will be strong support over here. Yeah. And then there's a question on the CFA REIT. CFA REIT, I think it's moving sideways with resistance still holding at around 78.5 cents and support at 77 cents. Yeah. So could be quite sideways still. Then for CLR, which is the Phillip S REIT, also pretty sideways at 80 cents is the resistance. And above that, it's also 81.5 cents probably. And for now, I think probably just moving sideways at 78 cents to 80 cents for these two REIT ETFs. Okay, I'll just take the last four key questions. For first one, ThaiBev. For ThaiBev, I think we're still seeing the weakness in terms of the share price. Yeah, last Thursday we broke down this 45.5 cents level. So I think we could see the weakness continue to test the next level, maybe at 43 cents, and then the very strong support will be somewhere close to 40.5 cents. Yeah. And next one, Digital Core REIT. Digital REIT, I think nothing much, just quite sideways with support at 48.5 cents and resistance at 52 to 53 cents area for now. So it should be quite sideways then. And for Semco industry, still trending well in this uptrend. So moving a bit sideways for now, I guess, with somewhere like 675 to 685 as some support, then resistance is like somewhere close to 710. Okay, then Capital DC I covered. So I think that's all for the TA. Yeah, I'll hand back time to my colleagues and Paul if you have anything to add on.
Okay, thanks everyone for your time. Hope it was useful, and sign up for our Singapore and US strategy on Saturday, and thanks for everything, and also sign up for some of our events if you have the time, like Capital Infrastructure Trust tomorrow. Thank you everybody, and have a good week ahead. Yeah, bye bye.